Hi, this is Duane McAllister with Baird Advisors. I'm here today to talk a bit about our most recent white paper called Better Together. The focus of this paper is really to look to the benefits of using both taxable and tax-exempt investments in your fixed income allocation. And the target audience for our paper really are those that fall into the more moderate income tax brackets. The paper starts with really an analysis of the differences between the two markets. The taxable market is much larger than the tax-exempt market. It's dominated by institutional investors and is traded around the world. In the municipal market, it's much smaller. It's about 1/10 the size of the taxable market at $3.8 trillion. And the daily trading volume is just over 1% that of the taxable market. There are other differences as well. Issuance on the Treasury side, the Treasury curve specifically, is heavily weighted towards the front end of the curve. In fact, 69% of all Treasury issuance is in 5 years or shorter maturities. In contrast, in the tax-exempt market, most municipalities want to issue debt longer on the curve to match the long-term liabilities of their assets, such as a school building or a toll road or an airport. So that puts upward pressure on the long end of the municipal market. The result of all of this is you have two different markets and two different curves. The Treasury curve is very flat. In fact, it's inverted on the front end of the curve today, where short-term rates are actually higher than intermediate rates. And so you have a very flat Treasury curve. On the municipal market, very strong demand for front-end short-term munis has pushed down rates on the municipal market, yet the lack of demand on the long end has pushed up rates on the long end of the municipal market. So the question is, how does an investor take advantage of this? One way to take advantage of this is to gross up the yield of the tax-exempt market so that it's on an even playing field with the taxable market. And when you do that, you'll identify what we call a crossover or indifference point, whereas an investor, depending on your tax bracket, you're indifferent as to whether you invest in the taxable or tax-exempt markets. Shorter than the indifference point, you'll find an aversion, a preference, if you will, for the taxable market. Longer than the indifference point, you'll find a preference for the tax-exempt market. And so it's a way to guide investors across both markets to use the taxable market for the short end of their investments typically. That would be most advantageous today. And to use the tax-exempt market for your intermediate to long-term investments. The combination of the two produces a higher, more efficient portfolio for investors. So that really is the focus of the paper. Thank you for your time, and if you have any questions, please don't hesitate to reach out. Thank you very much.